I'm Simon Hildry, and with me is Neil and Craig of the largest UK Opportunities Fund to talk about the economy and markets. The UK market has reached a record high recently. It doesn't necessarily feel like that. What's going on?
It's a good question, Simon, but over history, there's very little correlation between economic growth and stock market performance. Indeed, some studies suggest an even slightly negative correlation between the two. And in a UK context, that's particularly pronounced given the number of large multinational companies who earn their revenues in dollars. So it's quite possible that these businesses could be doing very well because international growth is better than it is in the UK. And that then becomes reflected in the stock market.
And obviously smaller mid-cap companies have underperformed. Have you seen any signs of a kind of rotation?
Well, interestingly, despite that strong performance of large and multinational stocks, over the last couple of months we've seen a real pickup in small and mid-cap companies. And there's a variety of drivers behind that. One, I think part of it is new Prime Minister, dare I say it, and potentially for a new broom and some perhaps more coherent policy making. Secondly, we've seen a large pickup in M&A activity, and that's been really focused in the small and mid-cap end of the market. And then perhaps lastly, what we're seeing globally is an acceleration in some of the softer economic data that suggests that global economic activity will accelerate into the second half. And as that does, it generally means that there's more earnings growth to go around, and therefore that tends to filter down and the equity market rally broadens out into small and mid-cap names.
And do you share that kind of, I suppose, cautious optimism about the economy at the moment?
Yes, I think the survey data has been encouraging. Now, obviously, we're in a very fluid situation given the conflict in the Middle East. But should we see a durable peace then, and I think we can see the oil price come down rapidly. I mean, the old maxim in commodity markets is that the best cure for high prices is high prices because it incentivises additional supply. And we could be rapidly heading to a world where every available barrel of oil is back on the market. And oil could overshoot to the downside, and if it does so, then we think there's scope for central banks to cut both in the UK and internationally. Indeed, it was very interesting reading the Bank of England's recent monthly report, which demonstrated that the BOE's reaction function is very much dependent on the price of oil. If we look at the actual underlying economic activity, inflation's coming down, albeit still above target. The labour market is softening. Services inflation is softening. And now those, in the absence of the conflict in the Middle East, those would all be indicative of lower, not higher rates.
I was going to say, so really the thing about whether rates are coming down is really dependent on the Middle East, basically.
Very much so in the UK context. And as I say, it was stark reading the latest pronouncements from the BOE, just how explicit they were about the importance of oil in that.
And what are companies telling you? You do a lot of company meetings. What are they telling you about the economy?
Right now, it's safe to say that not many companies are feeling particularly buoyant, especially those exposed to the UK domestic economy. But neither is it terrible. It's sort of bumping along the bottom for many companies out there. You know, we speak with the house building companies. I think we all know right now, as mortgage rates have increased, it's been tougher than we'd hoped at the start of the year. But by the same token, inquiries levels are holding up reasonably well. We had an update from Persimmon that was okay. It wasn't stellar by any stretch of the imagination, but it was fine. We've had quite a few of the retailers in the UK, when we've spoke with them or listened to the calls of late, who have been incrementally more positive now, whether that's just because everyone's enjoying the good weather or whether it is the early signs of a Burnham bounce and people getting genuinely more confident about the UK economy remains to be seen. But on the whole, I would say the companies we speak to, it's okay.
And I think it's important to note that at inflection points in economies, analysts typically underestimate the operational gearing in company forecasts. Now, we won't see so much of that this year, just given the uncertainty, and things have been subdued for a while. So many companies are putting additional expenditure back in, such as paying variable bonuses for the first time in a number of years. But as we enter 27, there's real scope for some of these companies to surprise materially to the upside in terms of earnings projections if that top line comes through.
Are you making any changes in the fund in anticipation of that, or is that too soon?
Not specifically. We came into the year in anticipation of global economic growth accelerating, inflation coming back down, and a broadening in economic activity. So the fund had a difficult February and into March, but it's rebounded back strongly, and so positioning's has been kept the same. But what's been interesting is just the level of M&A activity. I mean, we are overweight industrials, overweight domestic cyclicals. On the industrial side, we've seen a bid for Bodycote, we've seen a bid for Senior, to name two. Tate & Lyle's not an industrial per se, but that was another holding in the fund that was been bid for. So with that combination of improving economic outlook, attractive valuations and a pickup in M&A activity, we think the fund's very well positioned for the next 12 to 18 months.
How do you see M&A? Because it's a bit of a double-edged sword for fund managers, isn't it? With good companies being taken over, but...
It is, but I mean, ultimately, you reap what you sow. The UK market has seen continuous outflows. Now, that's not fund managers' fault, but it's seen outflows. And if international investors or corporates see good value here and they want to come in and pay big premiums in many instances. I mean, the Rotork, which is acquired by ABB, at I think almost a 70% premium. And if that puts money back into fund managers' pockets, which then can potentially bid up asset prices over the longer term, yes, it comes at the price of a slightly smaller opportunity set. But the UK's still got is a very large and diversified market relative to many others.
Just want to go back to Andy Burnham. Andy Burnham's this look at devolution and helping regions. Do you see a positive impact in terms of economies around the UK from that?
Examples from other countries would tell you is, sadly, again, a bit of a mixed bag. Now, the UK is, in developed economies, one of those that is the most centralised in terms of its tax taking, where tax comes in. Anything to increase that, you might think that's a positive because mayors, etc., local people know the best place to invest. They know what their strengths of their regions are. They know how to target this investment. What you're already seeing, though, is the disputes that are going to come on the back of this. You're seeing the Ben Houchin, who is in the northeast. He's already said he would like to give any tax revenue that he gets back as a rebate. And the government's already saying, no, that's not allowed. So I think you're going to see a lot more disputes when the rubber hits the road on how this money really is spent.
Thank you, Neil. Thank you, Craig. And thank you for watching.